Hi folks, Scott here, and this is the wrap for Monday, August 26th. Interesting day today. Ended up being nearly an outside day. Put in a higher high, but not a lower low, which would be the definition of an outside day. That's not in play, but a unique pattern that will not show up in our worksheet, which I post around 6 p.m. Eastern Time each night, actually a little earlier most nights because I do it right after this video. So one pattern that's not going to show up but is worth noting to you right now is what I call a 50-day moving average down straddle. A down straddle is a situation where you've closed below the 50-day moving average, but you straddled the 50-day moving average during the day because you closed above it on the prior day. So close below the 50-day moving average, this blue line, after closing above it. And also, just as an added filter, above the 200-day moving average. And there you go. Now those are the results of fading gaps, that's shorting up gaps or buying down gaps at the open that met the following criteria. The prior day closed below the 50-day moving average after closing above it on that prior day. And you see a couple things here. One, it's at least a 2-to-1 odds of gapping down on the gapping up on the subsequent day. That would make a short trade. Where a gap up you would short, a gap down you would buy if you're a fader like we are. So has a good average historical win rate, 70%, right in line with all gaps, but has been a big money loser using an end of day stop because it has been prone to trades running against you if you shorted them in the open, as evidenced by that one monster loser. Now this assumes 10 contracts. You can divide all these numbers by 10 if you only trade one or what have you. But still, that's a big loser no matter how you slice it. So it has been prone to running against you with a profit factor of only 0.6. Would have lost you a lot of money using an end of the day stop. Now, don't use an end of the day stop. It's a good place to start your analysis, though. Using an end of the day stop, however, down gaps look good, right? 15 of 18 winners. So I will rerun these numbers for our members in the morning, confirming how tradable a down gap may be, meaning with an intraday stop, is this still a good number? And sometimes these bad numbers here with an intraday stop still end up being okay because they tend to be binary sometimes, meaning the winners you could have caught with a reasonable stop. So we'll see if that's the case tomorrow for an up gap. But on the surface, looks like there's a clear long bias going into tomorrow. Alright, so over the weekend, let me show you, or I should say going into today, Monday, here's what the worksheet showed. We have a small gaps in mixed zones and directions. There was a small window of opportunity to gap up between the high and the close in some indices that looked good. That would have been a winner, but the gaps were just too small and even mixed directions in some cases. The unique data for up versus down gaps were pretty mixed. It showed risk for down gaps in both scenarios. Up gaps were more mixed, though nothing overly compelling. Per my worksheet comments, I showed a couple other unique patterns. Up gaps, correction gaps on Mondays after closing below the 10-day moving average and above a 200 have been problematic in both directions. And same thing with following two higher closes that were preceded by a 20-day low close. So both these unique patterns, though this isn't a big sample size, did show risk for either way. So sort of an unstable pattern. And basically, as I said, mixed data, small gap size, and mixed directions equals an easy pass for me at the open. So I passed. And let me show you what it looked like on a 5-minute chart. Blue line is the prior day close. This is the Russell top left, SP top right, NASDAQ futures bottom left, and Dow futures bottom right. And you can see we had a small gap down. The white line is where we open, below the blue line in the Dow. White line's above the blue line in the S&P. Same with the Russell, and NASDAQ gapped up a little bit as well. So I passed on it, and then the 15-minute range guides came out, and they favored the high breakout a little bit. It was about 2 out of 3 favored the high breakout, and I passed on them. I thought we were too likely to run up and test some resistance. My first thought was to short 65.50, which would have been a winner today. I did not do that. I changed my mind in the trading room. Told folks I just didn't have enough evidence. So it was basically going to be a delayed entry of the high breakout because I just didn't have enough data supporting going short just above the prior highs. Often if you're just above the prior highs, it's going to run a bit more or break down. So it just seemed like a poor spot to go short. And if you got really lucky and held your tongue just right, you may have survived today's high fade, going short at 63 and a quarter. The high of the day was 67.50, a 4 1/4 point stop. Actually, probably would not have. It would have been buffaloed at the high of the day. So those that did the delayed entry, I know some folks did catch a nice winner for 4 points. I did set up the low fade. I thought the low fade was a pretty good looking trade. Let me show it to you today per the first hour guides. If you look at the low fade here, I'm looking for 55 and 1.1 weighted average. Check for the ES. YM is check. NASDAQ check. Russell check. 4 for 4 of the futures favored the low fade. And that, by the way, that's using the target always shown here and the stop shown here. So 4-point target, 4 1/4 point stop. Looking at the ETFs, neutral in the spider. That was a little bit of concern because that actually favored the low breakout, opposite direction. That looked more like an anomaly there because diamonds favored the low fade. Qs were right at it, just barely missing my win rate criteria, and same with the Russell. So all in all, it was worth a half-size trade. I set up a low fade at 1660, and I really thought we were looking pretty good today as we worked our way slowly and methodically down sideways. Thought we'd come down here, maybe do a fake out and bounce, but instead looked like we had some politicians speak about Syria and chemical weapons and that whole mess, tanked the markets and stopped me out for minus 4 1/4 points. So disappointing. That was my only trade of the day, but that's trading. And over time, those news reports and events always even out, in my opinion, and based upon my research. So I don't worry too much about them. A little disappointing, but tomorrow's another day, and that is the wrap for Monday, August 26th. Have a good one. Oh, and one more thing. I almost forgot. Tomorrow I'm doing a webinar for prospective members. If you're interested in membership, I'll answer your questions and take you through a basic run-through of how our members use our tools and get you more comfortable and demystify them, as I like to say, because I know it appears a little bit like black magic sometimes. We throw so much at you in these daily videos, but I'd rather share more than less in general. Check that out if you're interested in becoming a member. That's tomorrow the 27th. I'll even profile at least a group of you that may not be the optimal candidate to be a member. And as we like to say, we don't want to waste our time any more than you want to waste your money. So that's on the 27th. And then on the 28th is our big oil gap event. Definitely want to check that out. It is a paid event. In fact, another reason, if you're interested and can't decide between being a member or doing oil, do both, because you get a $50 discount if you're a member. So you can sign up for a trial member, check out a trial for $14, save $50 on the oil event here on the 28th. And you can follow the link to learn more about the product. In fact, I'll click on it right there, I think. Should pop up. There you go. So it's an advanced study of the opening gap. It breaks down the opening gap in crude oil. Now, you don't have to trade the CL futures. As I showed in my intro to trading oil, there's several instruments you can use to trade oil. They're all highly correlated with the price of oil. But you can see how we broke it down. Very extensive. In fact, this ends up being a 46-page document. Yeah, it says right there, 46 page by day of week, day of month, first and last trade day of the month, size of the gap, 6 different market conditions, opening zone, stop size, extended target, results of gap fill when targeting different percentages of the size of the gap, following unfilled down and up gaps. A ton of great tradable information. As we like to say, all you need to do is avoid one losing crude oil trade, and you more than likely have made up the cost of the entire product. So a little food for thought there. And anyhow, that's on the 28th. This will go up to $4.97 starting on Thursday. And that was it, folks. Have a great one, and we'll see you tomorrow. Take care.